If I told you that one of the best performing S&P 500 stocks of the last few years wasn't a chip maker or a software company, but a power company, would you believe me? Utilities are usually seen as slow, steady, dividend-only stocks, but NRG Energy delivered something very different. Over the last 5 years, NRG is often cited at about 508% total shareholder return, while the S&P 500 returned around 103% over the same period. And if you think that's just a lucky run, listen to this. Over the last 10 years, NRG's total shareholder return is commonly quoted around 1,628% compared to about 290% for the S&P 500. That means $10,000 invested 10 years ago with dividends reinvested could be worth about $172,800 today. So what is going on with NRG Energy? Everyone talks about NVIDIA AI chips and the cloud, but almost nobody talks about what powers it all. AI isn't just software, it's concrete, steel, chips, and above all, electricity. And the same is true for the next wave of electrification, electric vehicles. As EV adoption grows, more people charge at home, more demand shifts into neighborhoods, and electricity becomes even more central to daily life. So if AI and EVs are defining technologies of the next era, the backbone is still the same: power generation, grid reliability, and energy retail. And that's where NRG comes in, especially in Texas, where data center demand and population growth are reshaping the energy market. Today, we're breaking down how this boring business delivered tech stock-like returns and whether it still has room to run. NRG is not a traditional regulated utility where profits are capped and rates are set by regulators. NRG is a competitive power and retail energy company. It sells electricity and natural gas plants to homes and businesses, and also owns power generation assets. NRG serves about 8 million customers across the US and Canada. It has sales across 25 US states, the District of Columbia, and multiple provinces in Canada. NRG is also one of the biggest competitive power and retail players in the country, often described as selling about 3 to 4% of all electricity in the United States. And it's not alone. Its main rivals include Vistra, Constellation, Calpine, and large regional utilities, competing for customers in Texas and other deregulated markets. Quick reminder, this video is for education and information only, not financial advice. And if you're finding value so far, please like and subscribe. It really supports the work and helps the channel grow. NRG owns and operates power plants. Today, it controls about 13 gigawatts of generation capacity. Much of its own generation is still fossil-heavy, primarily natural gas, with smaller portions from other sources, including batteries and some renewables. But here's the strategic shift. NRG is pursuing the LS Power deal, expected around 2026. If it closes, NRG's generation capacity could rise from 13 gigawatts to roughly 25 gigawatts, nearly doubling. That matters because US power demand is accelerating again, driven by population growth, industrial expansion, EV charging, and AI data centers. Let's translate those big returns into something tangible. NRG's 5-year CAGR is roughly 43%, which corresponds to about 508% total return. And its 10-year CAGR is roughly 33%, which corresponds to about 1,628% total return. Now, if customer counts and electricity sales aren't exploding, why did the stock rise so much? Because NRG didn't win by selling 5 times more electricity. NRG won because it increased generation per share, improved its business mix, and aggressively returned cash to shareholders, especially through buybacks. Stable top line, big swings in profitability. NRG's revenue mix shows a company that evolved over time. It went from being heavily Texas-centered to becoming a multi-region platform with a major East business, and after 2023, a dedicated Vivint smart home segment. In recent years, total revenue has often hovered around $28 to $31 billion. But the more important story is profitability. A clean way to describe it is, Texas is often the anchor, big revenue and usually solid profit, but still sensitive to market prices and hedging. The East is the swing factor. When the market and hedges line up, it can generate huge profits. When volatility hits, it can take big losses. 2023 was the messy year for multiple players in competitive power. 2024 looked like a recovery year, with about $1.1 billion profit and $2.3 billion operating cash flow. So the market isn't pricing NRG as a simple kilowatt-hour growth story. It's pricing it as a cash flow plus capital allocation story. NRG has been very clear that it's returning capital aggressively. The company plans to repurchase around $1 per year of stock and grow the dividend around 7 to 9% annually, a growth rate it has targeted since 2021. Historically, the dividend yield often sat around 3 to 4%, but because the share price has risen so much, the yield has come down, closer to around 1% now. So even if the yield looks smaller today, the dividend itself has been growing. And in a buyback-heavy strategy, shrinking the share count makes each remaining share more valuable, boosting EPS and total return. Now here's what makes NRG unique among power companies. Vivint Smart Home. Vivint is NRG's inside-the-house platform. Security, cameras, sensors, smart locks, thermostats, automation, monitoring, all tied into an app. Vivint operates nationwide, installed across all 50 US states. And even though Vivint is still the smaller piece of NRG in revenue, it punches above its weight in profitability. In 2024, Vivint generated only about 7% of NRG's total revenue, but contributed around 25% of the company's adjusted EBITDA. That's a big deal, because subscription-style revenue tends to be stickier and more predictable than pure commodity power. And just to add a quick technical view, on the 2-year chart, NRG has recently dropped below its 20-day and 50-day moving averages, but it's still above the 200-day moving average. That usually suggests the stock may be in a consolidation phase, cooling off after a strong run, rather than breaking its long-term trend. We can't talk about a power company without talking about emissions. NRG has set targets aligned with 1.5 Greenhouse pathway, aiming to cut emissions versus its 2014 baseline and move toward net zero long-term. According to NRG's latest sustainability reporting, they've reduced emissions by about 58% from the 2014 baseline, of avoiding roughly 24 million metric tons of CO2. That progress came from portfolio changes, retiring or selling older assets, shifting generation mix, and cleaner sourcing strategies. But it's important to be honest, NRG is not a low-carbon utility yet, it's in transition. Another thing that surprises many people, NRG is heavily institution-owned. It's often cited that roughly 90% of NRG shares are held by institutions. Compare that with some of the famous stocks. Apple around 68%, Meta around 80%, Tesla often cited around 60%. So while many retail investors focus on the headline names, institutions have been heavily positioned in companies like NRG, quietly compounding massive returns. And as a fun historical note, Warren Buffett's Berkshire once owned NRG, but they exited more than a decade ago, so even he missed this one. Future tailwinds, migration, EVs, and the great AI build-out. So what could keep NRG's story going? First, demographics. From 2020 to 2024, Americans have been moving south and west. Florida and Texas lead the list in net domestic migration. Florida gained about 870,000 residents. Texas gained about 750,000, followed by states like North Carolina, South Carolina, Arizona, Tennessee, and Georgia. And Texas, NRG's most important market, has been especially strong. Between mid-2023 and mid-2024, Texas added roughly 560,000 people, more than any other state, pushing its population past 31 million and growing close to 2% in just 1 year. Some long-range projections even suggest Texas could exceed 42 million residents by 2060. More people means more homes, more AC load, more EV charging, more electricity demand. Second, EV adoption is rising long-term, and NRG's key markets overlap with major EV growth states. Texas is one of the larger EV states by total registrations, while several Northeast states have high EV share. Third, AI and data centers. Reuters described this as the great AI build-out, with Microsoft, Amazon, Meta, and Alphabet expected to spend around $350 billion combined in a year on AI and data center infrastructure. That matters because the biggest constraint is no longer chips, it's power and grid capacity. And the hotspots for this demand include Texas and the PJM corridor, both relevant regions for NRG's footprint and growth strategy. Conclusion. So, what do I think? NRG is a company in an old world business, electricity, but it's being pulled into a new era by AI data center demand, EV charging and electrification, demographic migration into key markets, an expanding generation footprint, and a shareholder return strategy built on buybacks and dividend growth. But it's not risk-free. Leverage, market volatility, weather, and emissions remain real factors. If you found value in this breakdown, please like and subscribe. And let me know in the comments, what do you think about NRG? And which company should we analyze next?